Imagine two people. Both read the same finance books, both watch the same YouTube channels, both know the same investing rules, both have spreadsheets proving they'll become millionaires. 10 years later, one of them is wealthy. The other is still stressed about money. How is that possible? The spreadsheet said they'd both win. The math was perfect. The assumptions were flawless. The returns were reasonable. Everything looked right. Until real life happened. Because real life doesn't care about your spreadsheet. Real life doesn't care about optimal assumptions. Real life doesn't care about your projected returns. Real life cares about behavior. And behavior destroys more wealth than bad investments ever will. Today, we're exposing one of the biggest lies in personal finance, the idea that the mathematically optimal decision is automatically the best decision. Because some of the most financially intelligent people I know are secretly trapped. Not by a lack of knowledge, but by an addiction to optimization. They're what I call spreadsheet millionaires. People who look rich on paper, but never quite arrive in real life. And by the end of this video, you'll understand why the smartest financial strategy isn't the one that wins on a spreadsheet. It's the one you can actually finish. But here's where this gets strange. Nearly every major financial debate, mortgages, credit cards, 401ks, Roth IRAs, car loans, even savings accounts, is based on a hidden assumption. An assumption that you're a robot. Always rational. Always disciplined. Always calm. Always perfect. But if that assumption is wrong, then the entire spreadsheet falls apart. And later in this video, I'll show you why one man with a mathematically inferior plan ended up wealthier than another man who followed the optimal strategy. The answer reveals something most finance influencers never talk about. Meet Marcus. Marcus loves financial podcasts, loves spreadsheets, loves calculating investment returns. He tracks everything, every dollar, every expense, every projection. According to Marcus's spreadsheet, he's crushing it. But there's one problem. Marcus has $6,000 on a credit card charging 22% interest. And he refuses to pay it off because the spreadsheet says the stock market returns around 10%. Why eliminate a debt costing 22% when you can invest for 10%? That sounds ridiculous. Yet millions of people make similar decisions every day because they confuse theoretical returns with real-world outcomes. Marcus feels smart. But every month, something invisible happens. His credit card company collects guaranteed money, while Marcus hopes for future money. One is certain. The other is hypothetical, and that difference changes everything. Imagine trying to fill a bathtub, but someone keeps pulling the drain plug. That's Marcus. Every month he pours money into investments, and every month interest leaks money away. The spreadsheet focuses on growth, but ignores drag. And wealth isn't just about acceleration, it's about resistance. A Formula One car is useless if the brakes are locked, and a portfolio growing at 10% struggles when debt is destroying wealth at 22%. The shocking truth? Marcus isn't investing. He's subsidizing his lender. He's helping fund someone else's wealth while delaying his own. Now let's make it worse. Suppose Marcus earns 10%. Sounds great, except investment gains aren't always what you keep. Taxes take a bite. Inflation takes a bite. Fees take a bite. Behavior takes a bite. Suddenly that 10% starts looking much smaller. And this is where spreadsheets become dangerous. They show gross returns. Life operates on net returns. The number after reality takes its share. Now let's meet Jake. Jake did exactly what every finance article told him to do. Max out the 401k. Reduce taxable income. Invest consistently. For decades. And at age 62, Jake finally sees it. His statement shows $1.2 million. A millionaire. Success, at least that's what he thinks. Then reality enters the room. Because Jake forgot something. The government has been sitting at the table the entire time, silently, patiently, waiting. The IRS doesn't care what your statement says. The IRS cares what comes out. And when retirement arrives, Jake discovers a painful truth. Not every dollar on that statement belongs to him. Some of it belongs to his silent partner. This creates what I call the statement gap, the difference between what people think they own and what they actually keep. A retirement statement can create an illusion. A bigger number feels better. But bigger isn't always richer. What matters is spendable wealth. Not account balances, not screenshots, not net worth calculations, spendable wealth. The money you can actually use. And this changes how you view retirement planning entirely. Now let's leave investing for a moment, because the same mistake appears somewhere else. Car dealerships. Meet Travis. Travis arrives with cash, $30,000. He feels powerful. Cash is king. That's what everyone says. So he proudly announces it. I'm paying cash. The salesperson smiles. Travis feels like he just gained leverage. But he actually lost it. Because dealerships don't just sell cars, they sell finance. Financing is often where the biggest profits live. When Travis removed financing, he removed a major revenue source, which meant the dealership became less flexible. The result? He paid more. Not because he was stupid, because he misunderstood incentives. And incentives drive nearly every financial system. This is the lesson hiding underneath every financial decision. Most people ask, what should I do? Very few ask, how does the system make money? That second question changes everything. Because when you understand incentives, you stop getting manipulated by them. Now let's talk about something that feels completely safe. A high-yield savings account. Jordan loves his savings account. The bank pays him interest. His money feels secure. Everything seems fine. Until he realizes the bank is using his money to generate far larger profits elsewhere. The bank isn't your enemy. But it's not your friend either. It's a business. And businesses exist to earn spreads, the difference between what they pay you and what they earn from your money. Again, the spreadsheet sees one number, reality sees the entire system. But none of these examples explain the biggest problem. Human behavior. Because behavior destroys more wealth than taxes, more wealth than fees, more wealth than inflation. During bull markets, people feel brilliant. During crashes, people panic. They sell. They freeze. They stop investing. They abandon plans. And that's why average investor returns often lag far behind market returns. The market isn't the problem. Human psychology is, and no spreadsheet can fully model fear. So how do real people actually build wealth? Simple. Stop chasing optimal. Start chasing finishable. The best plan isn't the one with the highest projected return. It's the one you'll still follow during a recession, during a layoff, during a market crash, during uncertainty. Here's the framework. Step 1. Capture the employer match. Free money is free money. Take it. Step 2. Eliminate high-interest debt, not because it's mathematically perfect, because it creates stability. Momentum, confidence. Step 3. Build tax-efficient wealth. Think beyond today's tax bill. Think about future flexibility. Step 4. Automate everything possible. The less behavior required, the better the outcome. And step 5. Keep going. Because wealth is usually boring, not exciting, not dramatic, just consistent. Here's what took me years to understand. The goal of money isn't optimization. The goal of money is freedom. Freedom to change jobs. Freedom to move cities. Freedom to take risks. Freedom to sleep at night. And if your optimal plan keeps you stressed, anxious, and constantly second-guessing yourself, then maybe it isn't optimal at all. Maybe the spreadsheet is measuring the wrong thing. The biggest financial mistake isn't being bad at math. It's believing life behaves like math. Because life is messy. Humans are emotional. Markets are unpredictable. And the best financial strategy is rarely the most impressive one. It's the one that survives reality. So stop trying to become a spreadsheet millionaire. Become a real-life millionaire. The kind who finishes. The kind who stays invested. The kind who understands incentives. The kind who wins not because they found the perfect plan, but because they followed a good plan long enough for it to work. Comment below. Finishable beats optimal if you've ever abandoned a perfect financial plan. Subscribe our channel Wealth Explainer 62 for more videos exposing the hidden math behind money, because the most expensive financial myths are usually the ones everyone believes.